Joining us now to break down the market close and so much more, Eddie Ghabour, who is the co-owner of Key Advisors Group, LLC. Eddie, great to speak with you as always. Let's dive right in. Your big takeaway from today's trading activity.
You know, right now, this bull market is actually exceeding my expectations. I came into the year extremely bullish, as you well know, expecting double-digit returns, in my opinion, this year. But one thing short-term that does concern me right now, because I do look at fundamentals, is the market doesn't seem to be pricing in any negative news from the coronavirus. Yesterday was a prime example when you have a company like Apple that basically said they're going to take a decent revenue hit because of what's happening in China, and yet it just seems to bounce back. And that is a little bit concerning to me because I think short term we are overheated right now, because I think that we are going to see a revenue hit in this first quarter from China. It's almost impossible not to for the multinationals, because we still don't even know how much longer we're going to have this coronavirus quarantine and basically shut down certain parts of the world. So, of course, I'm excited with what the market's doing. I just think right now it's getting a little bit ahead of itself and not pricing in any bad news.
Well, I think part of it, and we've talked to analysts here on the show about this, is that there is no alternative, right? They're calling this now the TINA trade, right? And because if you look at yields in the 10-year, for example, I mean, it's under 1.8%, or today actually down to 1.6% in terms of the yield. So there's nothing to be found in terms of returns anywhere else. You got to go into these stocks, even though they are expensive. So I guess to that point, do you believe that this is a TINA trade situation that we've got going on? And at what point do you think that this might actually stop and that investors do pull back and maybe even get more into cash?
So frankly, I felt like that was why I was so bullish going into this year, is because rates were going to be down. So that dynamic of no other place to go, in my opinion, hasn't changed, because the Fed told us they were going to be accommodative. The 10-year Treasury note has been below 2%. I just feel like short term, we haven't priced anything in regards to a drop. So I feel like we are definitely due here sooner than later for some type of drop, not because it's the interest rates, but because, again, I think you're going to see more companies come out with guidance concerns, and eventually that will catch up to the market, because at the end of the day, the market, in my opinion, always will go back to fundamentals. And if you're taking revenue hits from several companies, then you can't justify certain PE ratios. So if investors are wise right now, do not be greedy. I would be taking money off the table short term if you're overweight equities at this point in time, because I think you're going to get a better entry point.
The Fed believes that consumers are strong, at least they did in their last meeting, but right now, are you seeing any weakness in certain sectors specifically tied to the consumer?
So the consumer absolutely is strong. That's what I believe is really holding up the U.S. economy right now. You know, 70% of our GDP is based on consumer spending, and those spending numbers still continue to be strong. However, because of the coronavirus, I think you're going to see travel and entertainment hit quite a bit. I mean, they're losing a tremendous amount of revenue. Not to mention the amount of folks that come here from overseas and spend money. And because of what's happening with the airlines and shutting down travel, you know, that's not priced in yet, and we haven't seen the results of that yet. So you're going to see some retail numbers take a hit as well, too. I feel like the consumer here domestically is healthy for 2020. I don't see a recession in 2020. I just see some type of short-term correction because of the negative impacts on the coronavirus that I frankly would buy, in my opinion, if you have the right risk tolerance.
Let's talk about the producer price index. New data coming out today also saying that it has seen its biggest one-month increase since October of 2018, getting up there about 0.5% in terms of that uptick in January. Is this a good sign or a bad sign that prices here are moving in this direction?
So, you know, you're going to see inflationary pressure as you're late stage in economic growth. And let's face it, we are late stages in this growth period. You know, one thing that would concern me from an investment perspective is this was a trend in regards to seeing prices and inflationary pressure get too hot. I don't think we can let one reading concern us. You know, our understanding in regards to the numbers that came out this morning was a lot of it due to service costs, mainly in healthcare. So again, our hope is, look, a little bit of inflation is good. We just don't want to see things get too overheated, because that's usually when you'll start to see recessionary concerns.
And so given recessionary concerns that we had been talking about even last year, some of the warning lights were flashing, thinking about the yield curve inversion, thinking about the uncertainty around U.S. and China trade at the time, some of that taken off the table, but some of it still looms. Ultimately, right now for the Fed, though, on a go-forward basis, what ammunition do they have left if we were to see ourselves start to wade into correction territory and then later on down the line into recession fear territory?
Well, due to the situation we're in where they've done so much easing between the lowering of rates, they're going to have to be very creative in what they're going to do. You know, you've heard some people talk about going into negative interest rates. I don't think that would be a good idea, but that's one thing in their tool chest. The other thing they could do is buy our bonds like they did during the last major recession. But the fact of the matter is, to your point, I agree, they don't have as many tools as they did back in 2008. Due to the fact that we've been in these low interest rate and stimulus economy for a very, very long time. And they didn't raise rates when they had opportunities to. And now we're stuck in this situation right now where it's going to be very, very disruptive if they start to change their monetary policy and try to increase interest rates. I don't think that's going to happen this year. And if I had to bet one way or another, I would bet they may even lower rates at some point in time this year. But look, the problem with all of this easing that's going on and money that's being injected into the system, everything from what the Fed is doing here domestically to what's happening in China, is eventually that party ends. And when that ends, if PE ratios are through the roof, then you start to have bubbles burst. And that's when you have a really, really violent move down in the markets and a bad recession. So, you know, it's going to be very, very tough to try to navigate through the next recession and try to make sure we have a soft landing and not a hard landing.
All right, Eddie, thank you as always for being with us. Eddie Ghabour is the co-owner at the Key Advisors Group, LLC. Thanks.
Thanks.
Thank you.